In this video, I am going to be sharing an amazing strategy to catch market pullbacks. But before we start, be sure to subscribe to our channel so that you don't miss on any of our new videos. With that being said, let's get into today's video. First, we need to understand how does the market move. The market moves in three phases: an uptrend, a downtrend, and a sideways range. When the market is in an uptrend, it does not move in a straight line. Instead, it moves in price swings. Price swings can also be called as price waves. A single price wave consists of two types of moves: an impulsive move and a corrective move. An impulsive move is a strong move that occurs in the direction of the trend. This means that in an uptrend, the up moves will be considered as an impulsive move. On the other hand, small moves that occur against the trend are called as corrective move. A corrective move can also be called as a pullback. In a downtrend, these small up moves will be called as pullbacks. These pullbacks give us the opportunity to enter the trend on a discount. Hence, our objective as a trader is to enter the market on these pullbacks and catch the trend. In order to achieve this, we will use three indicators. The first indicator is a moving average. Now, a moving average is a simple indicator that plots the average price of an asset over a particular period of time. For example, a 10-period moving average will give us the average price of the last 10 candles. Different moving averages can be used to identify different trends. For instance, a 200-period moving average is used to identify the long-term trend of the market. A 50-period moving average can be used to identify the medium-term trend of the market. And lastly, a 20-period moving average can be used to identify the short-term trend of the market. For this particular strategy, we will use the 200-period exponential moving average. We will use the 200-period EMA to identify the trend of the market. So, in an uptrend, we see that the price stays above the 200-period EMA, and the EMA is sloped upwards. Similarly, in a downtrend we see that the price stays below the EMA, and the EMA is sloped downwards. And in a sideways trend, we see that the price moves around the EMA, and the EMA stays flat. We will only trade in a trending market. Now the second indicator that we will use is the Fibonacci retracement. Fibonacci is not an indicator, but it's more like a tool that helps us in identifying the area of support and resistance. This is how the Fibonacci retracement tool looks. It consists of 5 lines. In the Fibonacci retracement, we first identify an impulsive move. For instance, we take this particular move. Then we plot the Fibonacci retracement tool by connecting the low and the high of the impulsive move in question. So, we make sure that the topmost line touches the high of the move, and the bottommost line touches the low of the move. The 3 lines in the middle are the actual retracement levels. The first one is a 38.2% retracement level. This means that this line marks a 38.2% of the impulsive move. Similarly, the second line is a 50% retracement level. In other words, it is exactly the halfway point of the impulsive move. And lastly, we have the 61.8% retracement level. So, the premise of the Fibonacci retracement tool is that we expect the price to pull back and find support at one of these levels. And eventually the price will resume the uptrend. Similarly, in a downtrend, we take an impulsive move and plot a Fibonacci retracement tool. We can expect the price to pull back and find resistance on one of these 3 levels. After touching these lines, the price will resume the downtrend. The third and the last indicator that we will use is the stochastic indicator. The stochastic indicator is a simple oscillator that compares the current price of the asset with the highest and the lowest price over a particular period of time. The default value of the stochastic oscillator is 14. Now, the stochastic indicator consists of two lines. The blue line is called as the %K line. %K line simply shows the value of the current close compared to the high and low. The orange line here is the %D line. Now, the %D line is simply a 3-period moving average of the %K line. Just like other oscillators, the stochastics also has overbought and oversold levels. Typically, when the stochastics goes above 80, it is considered as overbought. This means that we can expect a downwards move. On the other hand, if the stochastics goes below 20, it is considered as oversold and hence, we can expect an upwards move. We will combine all of these three indicators to successfully identify and trade market pullbacks. So let us now get into the strategy. Look at this chart. Here we have the Euro-USD pair on a 15-minute chart. The first step is to identify the trend. Here we see that the price is above the moving average and the EMA is sloped upwards. Hence, we can conclude that the price is in an uptrend. So, we will only be looking and buying trades. Now the second step is to plot the Fibonacci retracement. For that we need to identify an impulsive move. Here is the impulsive move. We will plot the Fibonacci retracement by connecting the high and the low. This is how the tool looks. So now, we are expecting the price to make a pullback to one of these three lines and find support. When it touches one of these three lines, we want the stochastic to cross above the 20 level. That would indicate that the stochastics is coming out of an oversold area, and we can expect the price to move higher. The third step is to wait for our entry. Here is our entry. Here we see that the price finds support at the 50% retracement level, and we also see that the stochastic indicator has just closed above the 20 level. This indicates that the pullback is potentially over, and we can expect the prices to move upwards. So, we buy the pair here. When it comes to stop loss, we will keep it at one retracement level below the entry. For instance, if the price finds support at the 38.2% level, we will keep our stop loss below the 50% level. But in this case, the price found support at 50% level and hence, we will keep our stop loss below the 61.8% level. And we will keep our targets at 1.5:1 risk to reward ratio. As you can see, we made profits on this trade. Now let us look at a sell trade. Here we can see that the price is below the 200-period EMA, and the EMA is sloped downwards. This indicates that the price is in a downtrend. Hence, we will only look at selling opportunities. After identifying the trend, we will identify the recent impulsive move and plot the Fibonacci retracement level. Here is the recent impulsive move. We connect the high and low of this move to plot the Fibonacci levels. Now we wait for our entry. Here is our entry. Here we see that the price finds resistance near this retracement level. And we can also see that the price crosses the 80 level on the stochastics and closes below 80. This indicates that the price was previously overbought, and now it has started a down move. So, we sell here and keep our stop loss above this retracement level. We will keep our targets at 1.5:1 risk to reward ratio. As you can see, the price did come close to our stop loss here, but it immediately reversed and gave a strong down move. This brings us to the end of this video. If you like the video, then be sure to subscribe to our channel so that you don't miss on any of our new videos.